Since the start of this year, we've been watching multiple asset classes sell off. This has hit the stock market hard, but it's also now working its way through the bond market. I'm going to walk you through what's happening in the markets and why, what this means for investors, and how this new trend could change the concept of money management, a multi-trillion-dollar industry. Stocks and bonds are both sinking because the Federal Reserve is expected to begin responding to rising inflation by raising US interest rates. Higher rates from the Fed means higher rates on US government bonds. The US government is one of the most trusted institutions in the world, so when its rates go up, other companies' rates have to go up as well because investors would rather put their money with the US government, but they'll give it to corporations if it means they can earn a little more. Those higher rates mean lower bond prices. So you're seeing prices sink across the board. Higher interest rates also mean it costs companies more to borrow, which can eat into their future profits and hurt stock prices. So stock prices and bond prices have been falling at the same time. The market sell-off seems to be hitting everything because it's all related. When interest rates rise, it makes investors reevaluate their choices and consider whether these companies are worth the incredibly high valuations they currently have. Stock market downturns are actually pretty normal. What's unusual right now is that investors typically buy bonds in times like these because they're considered safe investments. But with the Fed raising interest rates, bonds are selling off, even the most high-quality issues, which are considered to carry historically low risk. For investors, this means they have to rethink the way they manage risk. Bonds from governments and corporations with high credit ratings have for years played the role of stabilizers, meaning assets that hold up or even rise in price when stock prices go down. But since they aren't doing that, investors aren't able to use them to hedge or reduce their losses from the stock sell-off. Investors would also typically put money into savings vehicles during times of market stress like this. But with inflation running at 7.5%, and savings and money market accounts paying next to nothing, holding cash effectively means you're losing money. When inflation rises at 7.5%, what costs $1,000 today costs $1,075 next year. So if your $1,000 is still worth $1,000 a year from now, you've lost $75. The only asset class that has really held up during this current sell-off has been commodities. And commodities historically have been one of the riskiest investments in all of finance. This new environment has many rethinking the traditional investment portfolio of 60% stocks and 40% bonds. Professional investors have started doing this already, moving money out of bonds and into things like futures, private equity, and hedge fund investments. But those haven't performed well either. And importantly, they haven't shown themselves to move in the opposite direction of stock prices, the way bonds had for years. In this environment, there really hasn't been anywhere to hide from falling prices. With traditionally safe assets also losing value when the market is risk off, the only option may be to put money in different assets that have historically been pretty volatile and hope for the best. If you enjoyed this video, hit the like button. If you're interested in markets, subscribe to keep up with my latest. As the great Andre 3000 said, wealth is the word, rich is around the corner from the curb. See you next time.